Good morning or afternoon, everyone, wherever you are joining us from today. Welcome to the webinar on enhancing your financial management in SAP Business One. Today's session, we're going to dive into the core functionalities of SAP, specifically around optimizing cost management, streamlining budgeting, effectively managing fixed assets, and everything you should consider before implementing multiple branches, all within the core of SAP Business One. It's my pleasure to introduce today our speaker, Tim Parker. Tim is an experienced SAP Business One consultant, but also has over a decade of hands-on expertise as a controller and a director of finance, and can very much relate to many of your positions within your organizations. So we'll be making for a very practical session. Our Q&A is open, so please feel free to put your questions into the Q&A. We will address them at the end of the session, but please ask your questions as we're going through this. So thank you again, everybody, for joining us, and let's get started. And Tim, I'll hand it over to you.
Perfect. All right, welcome everyone. Just echoing what Renee said. So my name's Tim. Met a lot of you already. I've been with Aclaris for a couple of years now, as Renee mentioned, just various financial roles, auditing, efficiencies, that kind of thing, controller roles. So I think to kind of view the system from the same perspective as most of you, I find it helpful, and hopefully it is for yourselves as well. Like we mentioned, the webinar will be recorded and available afterwards. So you can take notes, but we'll make everything available, as well as on probably our YouTube channel. The Aclaris YouTube channel will have access there. If we look at the agenda for today, essentially what we're trying to do is to achieve greater financial control and accuracy across your organization. So there's multiple modules that we're going to go through here. Like Renee mentioned, you might be using some of them. You may want to use some of them in the future, and maybe you utilizing some of them, but what are we going to go through might help you to utilize them slightly better for your organization. This is not obviously training. If you want like further detail and something may be interesting for you and you want to maybe set that up, or maybe a demo of it, or get a demo database set up that you can play in the system on one of these modules, and we can do that for you, and we can set up further meetings after this. Yeah, so like Renee mentioned, basically the workshop to equip you with the tools to optimize your cost management with your cost centers and your profit centers. And then from your budget side to streamline that budgeting process, and then also fixed assets to try and manage that within the system more effectively, reducing errors. And then for branches, really to maintain your financial consistency across multiple branches. And yeah, these kind of features will help with precise financial planning, and ensure that all aspects of your financial operations are aligned with your business objectives. So what we'll do is start with cost centers, dimensions and cost centers, and at the end, yeah, we can answer any questions on any of these modules. So with the SAP, for those of you that don't know, you have various 5 dimensions available. So if you look at this illustration here, there's one company of just 3 times for 3 dimensions. You have up to 5, like I mentioned, dimensions that you can use, and under each dimension will be multiple cost or profit centers. So for this company, they've got a location dimension, a department dimension, and a channel dimension. So they're utilizing 3 of those. Under each of these dimensions will be multiple cost centers. So this one has got a central location, an east location, and a west location, and then department, sales, administration, and warehouse. So the main purpose for your cost centers is really just for reporting purposes. What kind of reporting do you want to achieve? And what kind of reporting is required in your organization from a management point of view or head office point of view, whatever it may be. So it's used to aid in management decision making. But you can really go as far as you want to with this, depending on the cost centers that you have. So you could have a profit and loss statement by cost center, by East, and the sales by only East sales, for example. So you can split it however you want to slice and dice the reporting. Most of the time, what we do with the cost centers is when we have a new implementation, sometimes even re-implementation, or even your existing SAP, and we just want to add a certain thing like dimensions and cost centers. but it's a bigger thing when you're coming from a different legacy system. And your chart of accounts may be, fairly inflated. So we try and reduce the chart of accounts via various ways, item groups, customer groups, that kind of thing. But when it comes to reporting where you're wanting a P&L reporting, from sales, cost of sales, margins, right down to expense level, then cost centers is where it comes into play. And you might have a sales account for the East location, a sales account for the West location, and sales for the central, and then you've got a GL account for cost of sales for each of them. And then you may want reporting on each expense level. So you've got a expense of rental, for example, and a rental for West, rental for East, rental for central. The problem with that is your chart of accounts explodes. It becomes too big, too cumbersome. And then what happens is generally mistakes are made and it's not utilized properly. It takes a lot more effort to utilize that. So what we then say is let's just have one sales account and utilize cost centers. And then you've got one cost of sales and one set of expenses, GL accounts. And then you can still get the reporting by the location cost centers that you use or the department cost centers that you may be using. So you can generate a full profit and loss statement by cost center, obviously each dimension that you have, as well as a trial balance by cost center and multiple different specific cost center reports that are within SAP, standard SAP. So this would be like a direct allocation of cost centers. So if you have an invoice, a sale, and you want it for the East location, 100% of that invoice or that expense, whatever it's for, will go to that East location. The transaction is essentially tagged with that cost center. When it comes to indirect cost and revenue allocation, if you look at a department dimension, like we had just had, department, sales, admin, warehouse, you could say you want that expense, let's say it's a rental expense, you could want that rental expense to be split across various different departments. So if it's $500 worth of rental expense, you can say, okay, well, let's make a distribution rule called area. And if the total area of the whole building that your business occupies is 500 square feet, 100 square feet is sales, 200 is admin, and 200 is warehouse. When you process that invoice for rental, all $500 of that invoice is going to go to your rental expense account, but you want reporting on that, so you've got the area distribution rule. It will distribute that expense accordingly. 500 to that general ledger account for rental, but in your report, you can see 100 is allocated to a sales cost center, 200 to admin, and 200 to warehouse. So that kind of distribution, your indirect cost and revenue allocation distribution rules, you can set up accordingly for whatever meets your needs. You could allocate by percentage. You could allocate by ratio. Another example might be payroll. So you might have a certain number of employees. You could have 500 in total again, and 100 belong to the sales department. And when you allocate a payroll cost, you could use a distribution rule like that, and it will allocate a certain portion based on number of employees. So there are different ways that you can do it, and it's all tailor-made to your, organization. If you look at just a standard sales invoice, essentially each transaction is allocated a cost center or tagged with a cost center. So if we look at just to the department and the location cost centers, dimensions. For this example, this invoice, it has a sales cost center attached to it, and then the location would be East. So when the journal entry results from that AR invoice, the P&L profit and loss accounts that are in that journal entry have those cost centers based on those locations chosen. So it kind of distributes 100% of that because we've used 100% distribution rule for these cost centers. If you look at another one with a distribution rule, this one's multi-location. So as an example, this multi-location we set up, 60% of that will go, any cost or revenue would go to a East location, and 40% will go to the West location. So if you did an invoice here, this is an example for building rent, $10,000. What then would happen is full 10,000 goes to the office and building rent GL account. But in terms of a report and a cost center report, 60% is going to the east location and 40% to the west location. This is a standard distribution report. We just seen that example here. This example is $10,000, 6,000 to the east location and 4,000 to the west location. These other examples, 100% allocation. He has an invoice for $1,000, $1,000, 100% is going to the east location. So it kind of depends on what cost center or distribution rule that you've used within that dimension. And this one shows, this specific report will show you each general ledger account, every transaction that is done in that general ledger account that has a cost center assigned to it. There are other various cost center reports that are available as well. And the thing that you want to do is make sure you're going to get the reporting that you need out of it. So if it's a standard P&L statement, that's fine. If there's specific cost center reports that are available, like this distribution report, that works well as well. This is a standard P&L statement by cost center. To filter that out, you would go to point 1 here at expanded, and you choose your location, east, west, whatever the location. You might even want to filter by department as well. Hit update, and then you'd hit OK, and then it will generate your P&L statement. And that's going to show basically your P&L statement by that cost center. You may want to show them by multiple cost centers. If you want all of them included for the full company, you'd leave it blank. There are other ways we can do a custom report where it will show the P&L statement by each GL account in there, as well as each cost center in a different column. And then the total of all cost centers all in one kind of collated report, so that you don't have to run this each time for each multiple cost center under each of these dimensions. So that is available that we can do with you as well. Just depends on what you're wanting to do. With the cost centers, I know a lot of it, each transaction's got to be assigned a cost center and kind of tagged with that. We can automate that to an extent. It can be a manual process where the user chooses it, but we can automate it as well based on the logic you give. You may have certain locations with certain customers, and you say, if it's customer A, please make it the east location. And we can default that into each of your transactions, so the user doesn't need to do that. It kind of just reduces any errors and also time for the user, so it just populates automatically. Okay, so that's a brief overview of the cost centers. It's definitely a good tool to use, but again, you've got to decide what kind of reporting requirements you want, and you may be using cost centers for just locations, and that's fine. You may not need all that detail, and there are other ways you get that report, but it can be used quite comprehensively. So you just let us know if that's something that you want to explore, and we can set them up. All right, so the next topic on the agenda we're going to look at will be budgets. Budgets. So budgets within SAP is kind of standardized, and in a way, different organizations are using SAP. So it has to be quite a generic standard setup so that multiple organizations can utilize it. So it's essentially your general ledger account name. It's got a debit and credit as a budget, debit and credit as actual, and then you've got your differences and percentages. So it's just it's a standard budget, actual versus budgets per P&L account, your profit and loss accounts. From a setup point of view, obviously we'd work with you to set up and configure it. We'd show you how to do it. When you're actually bringing in your budgets, you can do them manually if you wanted, if it's not a large amount and not a lot of scenarios that you're doing, or you could import it, and we can import it for you. We can show you how to import it so that you can do those every year. It's fairly straightforward once you've learned how to do it, and we can do the training on that for you. But the initial side would be to set up the budget. So you initialize the budget functionality. That kind of involves set up in the general settings, and it kind of allocates each account, saying, okay, what accounts where you define your budget accounts. saying which general ledger accounts do you want to be included in the budget. And I'll show you in a slide further on where it allocates and it marks off that box saying it's relevant to the budget or not for those profit and loss accounts. And you can choose which ones you want to do. The next thing, what you do after initializing and defining those accounts would be your distribution method. So you can see here various methods. A common one that's used is equal. So you might have $120,000 in your sales budget for the year. If you choose an equal budget, it's going to be $10,000 every month for the 12 months of the year. There's ascending where it will go up every month, descending. You could choose a specific budget distribution method. So you could create your own one where you say, okay, well, I've got 10 accounts and 10% of the budget value. They all have different values, obviously, but 10% of it is for the first month, January, 20% for the second month, 5% for the third month, etc. And you would create that distribution method and you can assign it to the various accounts that you've got here. Probably the most common is the manual method, the distribution method. It does require a little bit more work, but essentially that's more customized to your company's needs, because you would have a budget, 120,000 for the year, but you've got it manually assigned to each month. So for this one, it's $10,000 in the first month, 5 in the second, 10 again in the third, etc. And you can define that how you want. So what would happen then is if you're manually doing it, you'd have a total annual budget for the account, and then you'd have that split between the 12 budgets, the 12 months of the year. We do have import files that help make that a bit quicker if that's going to take a while to capture it manually. So we could do it whichever way you wanted to do it. And once you define those distribution methods, obviously you put the amounts in, and then you can generate reports. You can generate standard budget reports, various different reports that you can do, a P&L budget. So the one thing to note is when we do the setup, when you initialize the budget functionality, it will ask you what you're wanting to budget against. So are you budgeting against purchase orders or just invoices, for example? And then it will say to you, what do you want to do? If a user is going to do a transaction, be it a purchase order or an invoice or a sales order, or whatever it is, if that transaction the user is going to do is going to take them over the budget, do you want it to just warn the user? Do you want it to block the user so they need approval in order to process that transaction? Or what do you want it to do? And it's going to ask you if you want to do that on an annual basis or a monthly basis, against your monthly budget or against your annual budget. So you can decide and determine how you want those warnings, or even no warning, to be set up. Most people just have a warning and they normally do it on the annual budget, but again, it depends on how much you utilize your budgets. The other thing, if you've got more specific requirements with budgets, we could utilize to an extent Excel report. It can kind of enhance your standard budget that you use, but that's again would have to be tailored to your individual requirements, and we could work with you on all of that. Yes, like I mentioned, there are various reports that you can generate. Each one has different kind of parameters, date ranges, maybe monthly, quarterly, annual budgets, that kind of thing. So yeah, we would work alongside you with to get that all configured, and then once it's done, you can then import or manually capture those yourselves every year. Like I was mentioning, in order to set it up, each GL account, your general ledger account, so this is a sales one, for example, you'd hit your account details, and you can see at point 3 if it's relevant to a budget or not. When we do the initial setup, we would mark all profit and loss accounts relevant to budget. And then when you create any new ones, you would then need to mark this off if you wanted it to be relevant to the budget. Most people, if they're going to do a budget, it's normally the whole profit and loss statement. So all of them would be that. So just bear that in mind when you do create any new general ledger accounts. Okay. So the budget setup, you can have multiple scenarios. So most people would have a main budget. and you'd say, okay, 100% of what I put in this budget is for this main budget, and that's what you're budgeting against. You may not have accounts that have budgeted values against, and that's okay too. You can show all of them here if you want or not. This is on the setups for the scenario, not the actual budget report though. Some people would say, okay, well, I might have a main budget, but I also want to know what would happen if I do really well this year, maybe an extra 20%. So the second line here, call it optimistic budget, and that's 120% based off the main budget. So whatever you put in here, it's an extra 20% on top of that, and that links to. You don't have to link it to anything. You can create multiple scenarios of your own that are standalone, and then you can extract or generate budget reports that are specific to one of the scenarios that you choose, and you can have different scenarios in each kind of year. So each fiscal year has its own scenarios, and you create the new ones again the next year. Okay, so those are your budget scenarios. In terms of a budget report, this is your main budget report. Standard general ledger accounts, you can have them at any level that you want. Maybe if you've got multiple companies, you can all have at level 3. This is sitting at a level 4 here. And then this is the GL account level here. Budget, actual, your differences, and then the percentage. Yeah, like I said, you can run these in different ways. This one's just run annually, and it's a standard report. The other one that is a good report that's often used is the budget report, is a profit and loss statement budget report. So this is just a standard P&L, budget, actual, difference again at whatever level that you've got. So the setup for budgets is not, it's not too long. The initial configuration and everything like that doesn't take us too long. And then it's annually whether you want us to do it or yourselves, and we can show you how to import it or capture it manually. So it's not too difficult to do that. And it's just, it goes as far as you want to utilize it for the full budgets. So yeah, I think it's a good reporting tool. It is standard. So if your budgets are fairly comprehensive, we'd work with you and try and maybe have some sort of custom Excel report that we would utilize alongside it. But from a standard point of view, they work fairly well. Okay, so that's budgets. I think like all accountants, we're glad they are over. We are going on to fixed assets. So for me, since I've been working with the Claros, the people that utilize fixed assets, it works well for them. But most people have not actually implemented the fixed asset yet. And the reason for that, I think it's underutilized, is people just happy to carry on with their fixed asset register. And fair enough, that's fine. But if your fixed asset register starts getting quite cumbersome, auditors keep wanting to check it if it's a large value, there's a large volume of it, of transactions, of assets in there. It may be worthwhile to bring it into SAP. The initial configuration, there's a little bit of work on that, but all the detail is there in your fixed asset register already. So I think it's a good tool to get away from a basic Excel fixed asset register. It will reduce any errors because you'd be utilizing the system to process depreciation every month. It's a lot more efficient, a lot quicker. It's just a click of the button if your master data and all of that is set up correctly. And you've got an integrated ERP system already, so it's a worthwhile thing to utilize. And then your master data within SAP, you can set it up and have various different things. You can set locations and employees to the assets, different attributes onto it, names, serial numbers, whatever you want to do. You can put all that on the asset master data. It's a very similar master data to an item master data. And I'll show you a screenshot of that now. But it's a nice tool to use. There are a few things that you do need to do properly though when you use it. Just treat it the same as like your inventory module or your AR and AP. You've got control accounts, which you should not journal it to. So when we do implement that, we actually block the postings, manual postings to those general ledger accounts so that you can't do manual journal entries anymore, because it needs to come through transactions. So everything you do now needs to come through acquisitions or running a depreciation run and that kind of thing, rather than manual journal entries. Otherwise, your subledger is not going to agree to your chart of accounts. And then we've got so just bear that in mind, that no more journal entries once you go live with fixed assets. From a setup point of view, like I mentioned, very similar to a item master data, just got a fixed asset tab on the master data. If we've got an example here, like a truck, we have to set an asset class for each of the master data. So this asset class is called heavy vehicles, for example. And then under asset class, we would set up various things: depreciation area, account determination, depreciation type. You can have multiple ones of each of these, and then you assign them to the asset class. So for this heavy vehicles, we could have options of declining balance depreciation, straight line method, etc., etc. Which one's applicable to this specific truck heavy vehicles asset class? We'll choose straight line. The general ledger account determination, this is specific for this asset class again. It's got its own GL account determination where it tells each transaction and acquisition, depreciation, which general ledger accounts it wants it to hit. So you'd have to have that set up as well. And then your depreciation areas as well. Most people use GAAP. You can have as many as you want. The main area is the only one that's going to actually produce journal entry transactions. So you might have a useful life on this vehicle of 60 months, 5 years. And that is under your GAAP depreciation area. So when you depreciate that, it's 20% each year. From a CRA or like tax recoupment point of view, they may want that asset to be depreciated over 36 months, 3 years instead of 5. So you could have a separate area, not the main area, and a separate depreciation area called whatever you want to call it. And then you can also depreciate against that, but it doesn't actually process the transactions, but at least you can look at the you look at the net book value at any given time, and it kind of parallel captures those transactions for both areas. So we'll just choose the areas that you want in that asset class along with these, and that's how you do your fixed asset setup. More than likely, you're going to have to create general ledger accounts, new ones. You may want to split out your depreciation. You're going to have clearing accounts for your acquisitions when you purchase assets. Yeah, there are maybe recoupments, that kind of thing, revaluations, depending on how you want it to be transacted with. It will depend on which general ledger accounts you'd have to create. There are definitely a few mandatory ones that you need, but there might be a few that we'd have to add. So we'd work with you on that. When you look at the life cycle of an asset for master data, the first thing, like we mentioned, is to define the asset master data. Once that's done, then you can capitalize the asset. And by doing that, you do an AP invoice. And the AP invoice is created, no journal entries. The AP invoice is created, and then it automatically creates a capitalization document with that. And I'll show you how that kind of conjures out and on a clearing account. And then once that is added to the capitalized, then you are able to depreciate it. You might manually depreciate it or do the depreciation run, etc. There may be revaluations, any adjustments that may come into play as well. And then at the end of the useful life, or when you want to sell it, for example, you would then do a retirement. That retirement is kind of a inverse way of the capitalization. Is you do a retirement document, but it comes from the AR invoice. So you sell it, AR invoice, and it creates a retirement document automatically. We would do the training on that as well in terms of how to process things and how to add them and how it kind of works. So that kind of detail we do in a separate training. The whole purpose here is to run your depreciation quicker, reduce the errors of the user, and literally once it's all set up, you just click the button and it runs your depreciation every month, depending on what configuration has been done. All of those transactions are then registered into the fixed asset subledger, and they can be followed in the various dedicated reports. There are lots of different reports for in the fixed asset module, as well as just your standard GL accounts where you can see all the transactions. This is your asset master data. You can see it's very similar to the item master data. It's got a fixed asset tab here, obviously. Under your overview tab, you can see the asset class that we just looked at. So you choose that. Once you've chosen what asset class it is, then it pulls through the depreciation area that was linked to it. Useful life, remaining useful life, the depreciation type, straight line method, etc. Here's your area again. It tells you your net book value, your original cost. Under depreciation here, it will show you your planned depreciation, what has actually been depreciated, whether it was manually or accelerated or just a depreciation run was done. Here you've got options to capture locations and serial numbers, whatever kind of details that you want. And the point in having all of this is then you can also generate certain reports by that, and maybe even custom reports if that's what you're wanting. It has a capitalization date, and then it will still have a depreciation start and end date based on that capitalization date. That can kind of be amended, depends on your useful life, and we'd go through all of that in the training. And then you'd mark it off purchase item and sales if you want to sell it, depending if you're going to scrap it at the end of the year. You can create these manually. It depends how many fixed assets that you've got. We can also import them. It's a separate kind of import file, a different way to import them. But if there's quite a lot of it and a lot of data, then maybe an import is better. But yeah, if you've got a handful of them, creating them manually is not a problem either. And then once this is created, then you can start bringing in purchasing any assets, or we can bring in the existing assets, that kind of thing. Okay, from a capitalization point of view, when you purchase fixed assets, you do the AP invoice. It credits your vendor, debits your acquisition clearing account. Then it creates a capitalization document. It credits the clearing account and debits the balance sheet account. That's kind of just how the transaction works. So the asset history sheet, this is one of the reports. It kind of replaces your fixed asset register. You can show it for all fixed assets, specific ones. It shows you what balance sheet account it's for, the asset class, net book values, any useful life that's remaining, what capitalization dates, sub-acquisitions you've done. It has all the detail that you need on there. And you can issue it for all of them or a predefined range, like I was saying. Yeah, so this is a good report to use. It pretty much shows you everything that you need. There are other reports with other detail, but yeah, it kind of depends on what you're looking for. If I just finish off to say, I think the fixed assets, probably it's slightly better to go live with it at the beginning of a fiscal year. It's fine, you can do it whenever. It's just a little less detail and admin that's required or steps to take if it is at the beginning of a fiscal year. But we can go live with it whenever you kind of want. We'll just have to take 1 or 2 additional steps if it's during the fiscal year. Okay, so just if you do have the option, then yeah. Okay. Branches. Branches is something that's going to be specific, and I know some of you have heard me chat about these things before, and I've mentioned branches, and it's something that will be specific to your kind of organization, and each one has its own specific requirements. Some people have branches as small, different locations within one entity. Some are separate entities. It kind of depends on your own specific requirements. So we'd have to go through all that detail with you, but just as an overview, it's really for separate kind of business units or branches or locations that you would have. And that's why it would be used, because if you had separate databases, then what would be happening is you'd have to maintain separate master data, and that's kind of the bigger thing. So if you're updating items and business partners in the one separate database or entity, you're going to have to do it again if they're having the same master data in the other entity. So by having branches, you update it in one database, and it's all there for all the branches. But some people might need to create transactions by branch or filter data by a branch. You may want to see certain reports by a branch, like a balance sheet. So, for example, if you had locations as a cost center, that works fine, but you can do that to a P&L level. And there's certain reports that I'll show you in a screenshot later on, what the limitations on certain things are, be it cost centers or branches or that kind of thing. But you may have a branch that's got quite big now, and it's been working fine with cost centers, but now you want to see a balance sheet report, for example, of that branch. You can't do that with cost centers, so branches is probably then a better option. But it's definitely something that needs to be chatted about first before you just implement that. Yeah, so again, it depends on what reporting you need. You might have legal or statutory requirements that determine that it has to be a separate legal entity, it has to be a separate database, and it may not be. So I think just bear that in mind. If it is separate legal entities, maybe separate databases is the better idea. But we've done it with many that have separate legal entities and we use branches, and it works fine. It just depends on your own requirements. If you do have a separate localization, so a company in Canada and a company in the UK and a company in the US, those have different local currencies, and they're different country localizations, then we would recommend using separate databases for those legal entities, not branches. And you can kind of get around it, yes, but sometimes reports are restricted to local currency only, and then there's going to be a bit of a problem. So it's probably better to do separate entities for that. Separate, databases. In terms of master data, so branches for users or business partners, for example, you can assign to one branch, to many branches. A lot of the time when it comes to users, people will say, okay, well, I don't want people processing things in a different branch. So you can restrict their access by assigning that user to branch A and not branch B. It reduces errors, and it's just helpful to have that option. From a warehouse point of view, you assign to only one branch, and you have a default branch, a default warehouse per branch. For general ledger accounts, you can assign to one branch as well, or you can assign to available for all. You kind of leave it blank on the account details set up for that general ledger account. The only one you would probably assign to a specific branch would be something like a bank account. So that bank account belongs specifically to that branch. You don't want any other branch transactions to hit that general ledger account. Therefore, you assign it to branch A, and then only transactions for branch A can hit that. Okay, so if we look at the setup, you've got your branch name and address and legal details, that kind of thing. You'd also have a default customer and a default vendor that you'd create for the intercompany or interbranch transactions. So a lot of the time you're doing transfers between branch A and branch B. You do a sales order in branch A and a purchase order in branch B. We can automate that as well so that you don't have to do the other side of the transaction. So our technical guys can get, as you process a sales order, it automatically creates a purchase order, and then GRPO or and deliveries and AR and AP invoice, for example. So we can automate those if that's what you're wanting. And it just kind of reduces the time and admin you have to put in to process all those transactions. Here's the default warehouse that you'd put in for each of those branches. You can, maybe a branch is closed, it got small and it's closed. You would then just disable it over here. So you have that option and then it won't show up again. So, you won't be able to do reporting on that or anything anymore for current year if you disable that. And no transactions can go through to that anymore. So that's just standard branch setup. In terms of reports, this is kind of where it would determine if you would want to use branches or not. So you could do a balance sheet or a aging report. Under here, wherever it says expanded, and then you see the branch options, you can do a balance sheet for branch A and B, or all of them if you leave it blank, or just the one branch. So you can decide how you want to do that. You just understand that each transaction that is generated must have a branch allocated or selected. And when you do like a journal entry, it has to balance per branch. You can't debit branch A and then credit branch B in a journal entry. It needs to balance per branch because, well, you can generate a balance sheet, so it needs to balance. A lot of the time, what happens is like we just shown you now, if you've got inter-branch transactions, you've got sales orders, purchase orders, and invoices on each side. So what happens is generally then from an inter-branch, or if you've got companies, intercompany point of view, your sales, are overstated. Maybe your AR and AP includes your intercompany. So then what we do is we can eliminate those intercompany transactions for you. We won't eliminate them. Essentially, what we do is we'll create intercompany general ledger accounts, intercompany sales, cost of sales, AR, AP accounts. And then what we would then do is we'd already created intercompany customers and vendors where you would sell and trade between the branches when you're transferring between warehouses or whatever. And then you also create interbranch customer and vendor groups. And then we'd utilize advanced GL account determination. And if you don't know all of what I'm talking about, and you wanted this, we can show you this, but you then utilize advanced GL account determination, and using that, we would push those intercompany transactions to those newly created intercompany general ledger accounts. And then once you've done that, you can create a financial template. I mean, you could look on the chart of accounts, balance sheet, and it will say, your local accounts receivable, and then it will show the intercompany accounts receivable. And then on your P&L, it will be sales and intercompany sales. So you can see it identified on the face of the general ledger account. And then we'll also use financial templates where you've got like the standard one chart of accounts, and we create another one which eliminates those intercompany accounts so that your intercompany is already eliminated and it doesn't overstate it. So you might want to send statements to shareholders or the bank or whatever the case is, and it doesn't include inflated intercompany transactions. Yeah, so I think the different reports that you would need would determine if you wanted branches. Like here's an aging report as well. It's got the same thing. You click on branches, you can choose your branches. It all kind of comes down to what reports you want. If you wanted to investigate this further, then let us know, contact us. Just don't activate branches without asking us in your production database, because you will well, you'll regret it, because you're going to have to probably roll back a backup because you cannot reverse it once you've done that. So let us create a test database for you off your production, and then we'd activate branches in there. Yeah, and we'd help you along with that. Okay, this is just a reporting matrix that I kind of created. It illustrates the reporting capabilities of certain parameters and any like limitations you might have. Like I was mentioning, maybe you've got cost centers, but now you're saying, hey, I want a balance sheet. Well, you're not going to get that by cost center at least. And maybe a branch option, going to branches is worthwhile for you to do that, but maybe it's not. So it kind of depends on what reporting we normally, whenever we implement a new customer, and you'll know that if you've done that with us, is we kind of start off saying, okay, what item groups do you have? What customer groups and vendor groups do you have? Can we utilize business partner properties all to get your reporting requirements, to get reports that you want, that you normally have, or any new ones that you may require? And then if that's not enough, we say, okay, well, you may want full other reporting. We look at maybe cost centers or something like that. And then not as often, but branches then becomes an option. So this just kind of shows you what reporting there is available for each of these kind of parameters. And then on top of that, you've got stuff like Excel report and interactive analysis and all that kind of stuff where you could use to customize your reporting. But the standard reports from that, this is going to be your limitations. So hopefully that's helpful. Okay, so I know there was a lot to take in. I wouldn't say implement all 4 of these things in one, maybe one at a time, or if you are currently using one and you want to change or enhance it or utilize them a bit better, send us an email or something and we can connect and then set up a meeting and go through that. A lot of it is tailored to each company's specific needs. So this was just a general quick overview of everything, just so if you're not aware of it, this is the capabilities, they're standard, they're available in SAP, and you can utilize them. Yeah, all right. So just in summary, we went through cost centers, profit centers, what the benefits of using those are, especially from a reporting point of view. Budget's a standard budget setup, whether that would be useful to you to incorporate that and use that module. Fixed assets, a functionality, standard functionality there, and kind of how it works. And I think maybe getting away from the old school way of fixed asset registers in Excel, and I think bringing that into SAP is definitely beneficial. And then, yeah, the branches, again, very specific, but if that's something that, your locations or that might be growing quite big and now you want more comprehensive reporting, maybe branches is an option that you want to, an avenue you want to investigate. Okay, so thanks for listening. I think we're going to go into any questions if there are any.
We have a couple questions. Thanks, Tim. That was great. Great overview. First question that we have is from Victor at Burnett. Junior, he said, fixed assets. Can we run fiscal year change in fixed assets before our period end closing, or does it have to happen afterwards?
Probably before. Some will take like just before kind of thing, because normally when you do the fiscal year change in fixed assets, it's because you're wanting to process transactions in the new fiscal year for fixed assets. So there might be a period where you've got your auditor's adjustments, you're waiting for the audit to happen, so you haven't actually run the period end closing yet, but you need to actually process fixed assets. I always say run it before as close as possible. If you need to process them, run the fixed asset period closing, and then do the period end closing as soon as possible after that. If there's a gap, it's fine, but I'd say do the fixed assets one first.
Thanks, Tim. There's just an anonymous question. Yep. Yes, we will be sending this presentation out to everybody. So if you're on this recording, we will be sending you a link to the recording as well as this presentation that Tim has gone through. Okay. A few other questions that came up. Can distribution rules be set up on recurring transactions or journal entries?
Yes.
Yes. Okay.
Yes, on your recurring transactions, you have the option there to have your distribution rules. Yeah, the distribution rules, it depends on what kind of reporting you want when you do use those. But cost centers, obviously, definitely. But yeah, distribution rules can be done there as well.
Next question, are there any alerts for budget deviation so that we can get a warning if we're getting close or over?
It warns you when you're going, if that transaction you're going to do will take you over the budget. That's what it does. It will warn you. And it warns the user that's trying to process it. So you can block it if you want that user just to ignore it and there's going to be a problem, then you maybe want to block it. We could work with you to maybe do something specific to try and have an authorization come to a user or something like that, maybe something custom, but from a standard point of view, it's just going to do a warning or block it for the user who's actually processing that transaction.
Right. And then the last one that we have here is for fixed assets. Do you create one fixed asset master data for each piece of equipment, or does one master data represent multiple pieces of equipment?
Normally one for each piece of equipment. If you're doing something like you building a machine and it has multiple components to it, you'd have one master data. You'd bring in the first component as an acquisition, and then you'd bring in sub-acquisitions for each subsequent component after that. And that would add it to the cost of that one master data asset. If they 6 different vehicles, for example, then you're going to have 6 different master data. Each of the vehicles. They may all share the same asset class because they have the same depreciation and useful life and whatever else, but they're going to have separate master data. Same as items, in a way with the items, with some of them might be slightly different because of attributes, then you're going to have something as a different item number.
Great. Okay. Those are all of our questions for now. Thank you, Tim. That was great. If there's any other questions that come up, please feel free to just email b1support@aclaros.com. If you're lucky enough, you'll get Tim to answer it. Otherwise, you may get some of our other team members to help you. But if there's anything that is of interest as well, again, feel free to reach out to us. And if you want to start implementing or you just want to find out more about specific functionality, please let us know. We can obviously, of course, help get it set up in test environments and for you to try out before actually diving deep into it. Okay. All right. Thanks, Tim. And thank you, everybody. Have a good rest of your day.
Thanks, everyone.
All right. Bye.